Our next guest told us multiple times over the last month not to buy the dips after yesterday's market rout. Let's talk about whether things are any different now. Joining us, Allianz Chief Economic Advisor Mohamed El-Erian. After your last appearance, we actually had we put out a tweet that said 20 to 30%. Was that your intention of saying the market could eventually be down 20 to 30%? And is that still your feeling? Is it likely, or is it just possible? Or yesterday, did you feel any capitulation, Mohamed? Did you feel any better after that big rout?
Not as yet, Joe. I said 20 to 30 from the high.
I know.
We're down about 18 now, so
right.
We're looking at 2 to 12 from
We'd
here.
feel another 12, Mohamed.
Yeah, look. There is. You have to understand that what we're going to feel first and foremost is volatility. And that's what I've been saying for the last week. And that's why there are opportunities for certain investors, not the long-only investor. We're going to sense volatility because of three things. One is policy versus more demand and supply destruction. And the American and Delta news you've reported shows you what supply and demand destructions feed on itself. Two, we're going to have conflicting medical news. China, containment is possible. Italy, this thing spreads really quickly. Which is it? And finally, the technicals are fascinating. You have people who long that are still trapped, looking to go out, versus people looking to cover their shorts. So it's going to be very volatile, but around, unfortunately, a downward trend for now.
Okay. So, yeah, it sounded like you were switching to, well, I'm not sure about more downside, but I'm sure of the volatility. But you are saying both. There will be more volatility and wouldn't surprise you. So, I mean, you're only talking 2% to get to your lower bound of 20%. You think it's less likely we get to 30, or you think somewhere between 20 and 30% is still possible because we don't know what we don't know about how this pandemic, if you want to call it that yet, but how the coronavirus situation, we can't see into the future of how it plays out. But you think that we have not made the lows?
I don't think we've made the lows yet. Okay. But it is going to be incredibly choppy. And you've got to be aware of your behavior when you're taken out of your comfort zone. Investors make mistakes when they're taken out of their comfort zone. That's why it's very important to understand what is facing you so you don't get unsettled and do the wrong thing. Look, Joe, there is a whole host of uncertainties out there. But the biggest uncertainty is what I call the economics of fear. How will you and I react? Are we going to exaggerate the downward trend? Are we going to de-engage from the economy at a faster rate? If we do, then it's going to be pretty messy. So the hardest thing to predict in all this is the economics of fear.
I don't think any of us can deny that. I mean, we've at least done a few things differently at this point. Yeah, exactly. So, Mohamed, do you see any glimmers of hope in the 10-year, or do you think oil prices will continue to be a major story in terms of being much lower than people thought they would be, or do you think that both of those reverse some of the recent panic selling, or whatever you want to call it, panic buying in the bond market?
So on the 10-year, I was actually encouraged of the way it behaved yesterday. It behaved well, and that's good for the market as a whole. I remain concerned about the corporate bond market. Keep an eye on that. That is where the canary in the coal mine is, if you like. I'm really worried about what happens in that bond market because it will contaminate new issuance. And the minute you contaminate new issuance, it's hard to refund yourself. On oil, I think the worst is behind us. It was the shock of Saudi Arabia abandoning the swing producer role. Today, actually, the reaction of the market has been very muted, given that we got a second signal out of Saudi Arabia. On Saturday, the signal is price war. Today, the signal was price war and production war. They're increasing production by 20%. So the market actually has internalized that well. I think the biggest shock is behind us right now, and it was this change in regime from stabilizing prices to, you know what, I'm not going to play this role of swing producer anymore.
So I'm saying so now. I don't want to start every sentence with a so. Anyway, so
there you go.
The fiscal stuff that you've always wanted, and the Fed stuff that I don't know what they're going to do now. People think maybe even some QE or something at this point. But what would you like to see fiscally and from the Fed at this point to try to ameliorate the damage?
So, to use your phrase, on the fiscal side, I think we need targeted measures. And I've laid out in today's Financial Times the sequence for how you do that. I think we've got to be careful not to throw everything at it, because we're going to waste limited ammunition. That concept is especially important when you turn to the Fed. You heard me last week worry about the 50 basis points cut. They should not be doing general policy responses yet. It's like pushing on a string. Lower funding, lower mortgage rates aren't going to make us take a cruise. That's wasting valuable ammunition, but they should focus on market functioning. They should understand better the technicals of the market and be there to counter market malfunction. This is not about them supporting asset prices. This is them making sure that the market function well. And that's what they should be doing, laser-like, Joe, laser-like.
Okay. Yeah, we had. So you would disagree with our earlier guest host, Joe, about that there's still a place in the Fed's playbook to try to boost asset values and the wealth effect. You don't think that's part of it? Would you do? I mean, how much would you want for? I think you've always liked some fiscal help. How much would you want to do? Payroll? You'd want to do more than that? You'd want to do, for people to be sick pay?
I would like to do two things. One is give the medical profession more financial support. Two is protect the most vulnerable segments of society that are being hit hard for no reason. On support asset prices and the wealth effect, are we really going to take a cruise because we feel wealthier? I mean, we've got to be honest, right, as to how we change our behavior. Yeah, support balance sheets till tomorrow morning, but be clear that that's what you're doing. You're not going to reactivate economic activity. We need medical advances for that.